Today, more from the property market frontline. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I'm joined again by Chris Bates. Hello, Chris.
Hi, Martin. Good to see you.
Yeah, thanks for coming on and spending a bit of time with us once again. It seems as though every time we talk, there's always something really interesting going on. Last time it was the Royal Commission, this time it's negative gearing.
Yeah, I mean, the Royal Commission was just a bit of a farce, really, in the end, wasn't it? It hasn't. It was nowhere near as tough on lending, and I think lenders are definitely approving loans now. And the nonsense, I guess last year in the middle of the year, where loans were really getting rejected for all sorts of reasons, even if it was a great customer. A lot of that's gone now, and a lot of lenders are just back hungry for business again and are actually approving loans. So, for people who are borrowing out there, not that everyone should, but the people who are, I guess the lending things kind of. It's definitely much better than it was. So that's good news for the market, I guess.
Yes, and in fact, the latest statistics out today from the ABS shows just a very slight improvements in some sectors of the market, but nothing really you can write home about yet. But it looks as though perhaps there's a little bit more sensible ground emerging, which may be good ahead, but there are also a lot of down forces as well. Of course, we've got the election. Labor may win. If they do win, they're talking about changes to negative gearing, and that clearly then puts a whole new lens over the property sector, doesn't it?
Yeah, I think we've spoken about this before, and I've spoken about it a lot. If it does go ahead and they do put new restrictions in around, negative gearing and higher capital gains tax, without doubt the property market needs to be repriced because it's no longer as attractive to investors to invest. They're going to have to pay more tax, and even if they do want to invest, they're not going to be able to offset those losses. So we're going to have to see a repricing of property just more broadly because, investors a lot of the time won't enter the market. So you're going to have to, and that's going to obviously hit certain pockets of the market much harder than others, where investors have generally gone and invested in the past. If there's, 80, 90% of the properties are bought by investors in those areas, then, and if they're no longer buying there, who's buying there? And then I am quite worried, I guess, just more broadly for the market, I guess, in terms of how big does that contagion effect go, and does it not just affect kind of high investor market? Does it spread across just more broadly, and how bad does it get? I think it's a very dangerous policy at this time.
Well, certainly there are two aspects to it. The first is essentially no negative gearing for new existing purchase of existing properties, right? Yep. So you can still buy a new property off the plan or newly built and still get the negative gearing benefit, but not for existing property. And we know that quite a lot of investors previously were buying established properties and effectively investing in them. So that's the first part. The second part is the capital gains, which I think, as far as I understand it, and it's still a bit vague, covers the entire market. So it isn't just the existing property that's affected by it. Yeah,
I think, and that's it. If they do allow it for new property, it's assuming that investors are going to go out and buy new property. And, I think investors will figure it out pretty quickly. Well, if they want to sell that property, they can't sell it to someone who gets negative gearing. So unless that property is almost neutrally geared, they're only going to pay a price where they can sell it to the secondary market. And investors aren't that silly. So, and what you'll see is, there'll be all this buy a negative gear property, all over the papers. It's new, and it'll just be, exactly what the spruikers want, is creating this, demand for a product that, has been proven time and time again that the biggest losses in property are in your off-the-plan sales. And, all the property problems that we're really having, a lot of it's in the off-the-plan space. So you're just basically funneling people to the worst asset they could buy. And that could be outskirts, house and land packages. It could be new duplexes, southeast Queensland. These are all areas where, there's lots of supply, there's more and more land, and they can just keep building more of them. And that just defeats the whole purpose of any good investment, which you need limited supply.
Yeah. And it's interesting, of course, because as you say, there are a lot of issues with off the plan. We also know Opal Tower and some of the other newly constructed apartments are also potentially perhaps not constructed as well as they should be. In fact, there are new building regs coming in May, which may be a bit tighter, but sort of shut the door after the horse has bolted, and even then it may not be that flash anyway. So the new sector is already looking quite soft, and in fact, talking to some valuers the other day, they're talking about a 15 to 20% reduction in prices of some of this new stuff, simply because of all those risks and the lack of the lack of demand relative to very strong supply. And that's true particularly in Brisbane, but also in Melbourne and Sydney. So it doesn't look to me as though that new sector is going to suddenly take off and suddenly going to, support the whole market. Right, so that's the sort of the first point. And then the second point is the existing property. Well, we know that at the moment, a lot of property investors are not actually coming into the market. Firstly, because their rental returns are actually going backwards at the moment, and their prospective rental returns, particularly in Sydney, in some places are going backwards. But there is still a little bit of underlying demand from some selective areas and from some prospective property investors. So it seems to me that it's not going to be either everything's doom or everything's wonderful. We're going to find pockets of different behaviours and different types of customers and prospective buyers looking for different things.
Yeah, I think the new space, it didn't really go up in Brisbane. Like, new apartments didn't really go up. In Melbourne, they didn't really go up. Unfortunately, just in Sydney, they all went up. And then, there was this fear of missing out. Every investor, was buying, they can't afford a house, let's just buy an apartment. And that just pushed up the Sydney apartment market, much more than it did in Melbourne and Brisbane. There's lots of, you can easily see those figures. And that's where I think the big risk with the negative gearing change is that, Sydney apartments really are the ones where you look at the cash flow on a 2-bedroom, stock standard unit in an area where there's lots of supply, and you just think no investor is going to be crazy enough to buy this unless they got negatively geared. And if they can't get that, then that property has to fall, huge amounts, And so, I think the last thing anyone would want to be doing right now is buying, an apartment in Sydney, for example, because it's one of probably the most overpriced asset in a world without negatively gearing, basically. And I guess broadly on your comment around the quality of the build, what do you, even if they improve the standards after this date, unfortunately they all get kind of priced. Investors don't really understand, well, that's a better build than that one. They're just kind of comparing them all together. And even if you start building better apartments now, what do you do with all the old ones? You've got to either knock them down, and so we just created all this poor housing because they've all been sold to investors, and investors haven't wanted to pay, 750, 800,000. They just want something cheap that they can rent out and they can get a tenant for. And so they haven't demanded high quality assets. And so what we've ended up doing is just build, cheap and cheerful stuff, because that's easier to sell, and it's more people can afford it the cheaper you make it. So, if you're a developer, you wouldn't try to build something at 800,000. You try to build something at 600, and it's easy to sell, and you get onto your next project rather than trying to build this amazing stock that it's harder to sell.
Yeah, well, it's always a question of the market, and people obviously are very price sensitive. So if you can actually cut the corners off the price, then you will. And that, if that means using cheap materials, and if that means using particular types of labour, people are going to do that, aren't they?
Yeah, and so while I think things will improve, I think developers will change their tack. They'll start building for homeowners, and so I think a lot of the future housing will be driven by demand, and homeowners and families will start to demand a higher, better quality stock, and the government regulations. But I think the worry is all the stuff that we've built. We can't, and we've wasted a lot of land on poor quality buildings. Yeah. And you're right around the pockets. You mentioned there about the pockets. Well, some pockets will do well, and I think that's the most important thing for any of your listeners to understand is that the market never moves in one big cycle. It's actually, you've got to keep going deeper and deeper, and there's over 10 million properties in Australia, and some properties are going to get hit much harder than others. And I guess the properties that generally will do quite well, is where there is a shortage of supply and there's something really scarce around it, and that you can't really recreate that. So it's generally in the inner rings of your capital city. It's generally in your good streets in those areas. It's on the and it's kind of in those houses. They're not really coming on the market, and that's the big problem right now. Is that prices have come down, but no one's selling quality assets because you're not going to get a quality price right now. And so there's very few good properties coming on, and the ones that do come on, they are selling. There is competition for them. So and they're the really stuff that you want to invest in anyway. There's no point thinking about all these other properties because long term, if you want to buy a property, you've got to get something that goes up in value, and that's buying something quality. So I think that's the real challenge right now is that, we are seeing falls, but it's not the stuff that you want to buy anyway from an investment point of view. So, it's kind of a bit pointless.
And that's presumably why the stock of for sale properties is continuing to rise, because that's the thing that quite astonishes me. It's just that, there's lots of stuff available, but actually when you go look at it, it's not necessarily the high quality stuff, is it?
No, because, it's quite common now that people are getting more picky. As a buyer, I'm becoming, because A, there's no rush, there's no markets not going up on me, so I don't need to get in now or I'm going to miss the boat. And B, there's less competition. I've got more confidence, and so I'll just keep waiting. I'll wait for the market to maybe fall a bit, and I'll wait for something that comes up that's a bit better. But in a boom market, people don't think like that. They're so worried about the market moving on them, and they're getting priced out of this suburb, so they'll have to buy it here. And so what ends up happening is people end up buying everything. Even if it's on a busy road, if it's noisy, if it's got a really bad, layout, if it doesn't suit their family. They just buy it just for the sake of getting into the market, which is really the worst thing you can do. But those properties are just not selling because where the buyers, they're all getting dragged to the quality assets.
Yep, fair enough. And just sort of going through the segments in a bit more detail. First-time buyers, I mean, I get quite a few people who are first-time buyers. They've slaved up their 10% deposit or even 20% deposit, and they sort of say to me, well, should we buy, shouldn't we buy? And my response has been so far, don't think it's worth it at the moment because unless you really have to buy now, probably you can get a better deal later. Do you still think that's the same, or do you think that something is changing?
If it was not in these really inner ring kind of scarce assets at a price point that's, at the right price point, definitely not. Because end of the day, the buyers are all getting sucked to these assets, and then these are the assets that are most likely going to get competition in the short term and are most likely going to hold their value a lot more. And so, no, I wouldn't, because, the longer that this kind of process kind of plays out, is you're probably better off for a first home buyer to wait till next year. Let's see what happens with this, election, see what happens with negative gearing, and just see if that does freak out the market even more. And, I guess that if you're a first home buyer, then you are looking to buy, and it's in kind of an inner ring, and it's a good street, and it's, near the train, it ticks all your boxes. Unfortunately, those properties aren't coming up. And so really, if you're going to buy them now, you really want to buy it for a good price. And so that's the problem, is like a client missed out on a property on the weekend. There was 22 bidders on a beautiful terrace in Petersham. Domain reported on it. One of my clients bidded on that, but, he set his maximum up at 2 million. It ended up going for 2.25. And 2 million is probably a fair price for it in the current market. Unfortunately, it's just such a hot property that there was 22 bidders on it. And so he has to walk away. But if he paid 2.25 for it today, which someone did, and the market does cool off next year, that person could be in a bit of trouble because, they have overpaid for it in a bit of a falling market, if that makes sense. So I feel like the person buying that is just acting emotionally, got way excited for this property, and it's not really that market. Not every property's got 22 people on it. So that's the last thing I think people should be doing right now. Is getting way too excited and overpaying in this market. You really have to get it for a good price and get an absolute quality asset that even if there is a further price falls, your asset is still protected as much as possible.
Good advice there, Chris. And what about those people, perhaps who've got their older family, perhaps they've been in the property for quite a few years, they've got a lot of capital sitting in it, and they're now seeing the property prices beginning to slide, and they know that at some point they'll want to take that property, sell it, get something smaller and release some equity. They seem to me now to be in a rather difficult situation insofar that the longer they leave it, the more prices are going to fall.
It's a really interesting one. I literally just had a conversation before this at 12:30 with a new client over lunch, and and he was in that dilemma. Does he sell his house in Pymble, which is in the mid-2s, and does he move to his next house that he wants to kind of move into in the future? And there is a time frame where the kids in the next 5 years are going to finish school, and he's got this big house that he doesn't want to live in long term. So not only he doesn't have to sell it, but generally speaking, he does want to sell it in the the near term, and he wants to buy something else. So for him, what he wants to buy is moving to Avalon, which is probably a good asset as well. So it's really a case of, figuring out, if you're losing on the left hand, can you gain on the right hand? And can you get a good buy? And so I guess that's kind of what he's, but I mean, if you've got an asset, we spoke about this, if it was an asset that, it's unlikely that that asset's going to recover because it may be, extremely, like a lot of stuff far in the Western Sydney, is extremely highly priced and it's gone up a lot. And if you're looking to get out of that asset and it's unlikely it's going to recover, then you might want to just bank your money if you can get out. The problem is if you take a risky strategy where you get out of the market, you put that money in the bank, and you want to get back into the housing market because of the lifestyle benefits, etc. You've just got to be careful that the market doesn't do what you don't expect it to do, and the market goes up. And the area, especially where you want to buy, goes up, and you basically miss the market, and then you end up buying in areas that you don't want to live in. So I guess it's just you've got to be conscious of that risk. And does your personal situation change where you can't borrow that money in the future? So you might you might lose your job, or you might not be able to get get made redundant, and your salary goes from 200 grand to 100 grand or whatever it is, and you then can't borrow that money that you wanted to borrow. So you just got to be careful of that risk as well.
Yeah, one of the things that I say is if you're buying and selling at the same time, you only need one property, right, on both sides of the transaction. So if both are moving, up or down relatively similarly, you can still transact and actually not effectively take a hit. But you have to be very careful about that because quite often different markets move differentially. And as you say, if then there's also a timing difference, so effectively you sell first, but prices, don't move down as you expect, you can actually then find yourself in a rather difficult situation. This is a really complicated market. And I think a lot of people are now beginning to learn that, over the last 5 to 8 years, it was relatively simple because mostly it was always up.
Yeah.
It's not now. And this is a way, way more complicated situation. And just on complication, let's assume Labor gets in. Let's assume 1 Jan next year is when the legislation comes in. But what does that mean? Does that mean that people should be buying before 1 Jan? Do they have to complete before 1 Jan? I mean, it's not clear to me precisely what the rules will be yet.
No, I mean, the whole policies is where, I guess they're going for, X, and then if they don't get that, they might get X minus 1 or X minus 2, and we're not sure exactly. They may just go for capital gains tax, which, that's a win for both sides of the government long term, right? Both sides really would be happy for that just to slide through, and, it increases their future revenues, and no one will care too much if future investors have to pay more capital gains tax. Like, it's not really a big concern. But you're right, like around the negative gearing policies, we don't know whether it needs to settle or whether the contract needs to be exchanged, prior to January 1. And that's a big difference because you could have a very long settlement period of, sometimes years on, some properties. So that's going to be an interesting point. But if it is settled, that means generally a 4-week settlement's fast, but generally it's 6 weeks. So if they're going to settle before the 1st of January, it needs to be the middle of November. But, you don't really want to be pushing it right up to the end of the middle of November. You probably want to have a few months up your sleeve. So you're probably thinking maybe July, August, September, is when you want to be in the market because good assets, generally in these areas, you're only talking about a handful popping up every 6 months. Like, it's not every day, especially in this market. You'll get the busy roads, you'll get the, those properties are coming up, but it's the good ones, they're coming up, and then unfortunately a lot of them are still going for good prices, so you've got to kind of be in the market for a good 6 months generally to find something. So I would say if you are thinking about getting in before the change, which we don't know if it's going to happen or not, the election goes through, they win the election, it might get through in Parliament, I don't know, July, August, something like that, and then you've really got 2 or 3 months to get going. And it's just, I guess it's really thinking through, is that something that you'd want to consider for people watching your show, is just to say, is it worthwhile trying to get access to this negative gearing benefits, but also lower CGT over the next 20, 30 years? And that's kind of the big question for some people to think about. Is it worthwhile for them?
And the maths are complicated and lots of uncertainties ahead, of course. So it's really hard call, I think. Okay, Chris, the final question for you today then is, what do you think property prices are going to do over the next 12 months, particularly in and around Sydney, say?
I'm not confident at all around apartments, which I think I've said. Unless they're kind of 3-bedroom apartments, that are quite scarce in older blocks and they really suit families and downsizers, that's okay. But Everything else, not really at all. The outskirts of Sydney as well in the housing market, I really can't see anything that's really going to change that. I don't think confidence can turn around that fast. I don't think lending's going to, explode. I do think that, we are going to start seeing floors, though, in prices in good areas and good suburbs, because people are starting to, get more savings and more people are willing to upgrade. And I think, in the good areas, in the good streets, I think we're going to start to see some bit of competition again, But I can't see, there's only going to be a certain pockets at certain price points where either upgraders are buying or young first home buyers and families are buying. But, they're only going to buy the good stuff. They're not going to buy, the things that aren't suited. So, that's the only things I'd be buying in Sydney. And it's a very similar story in Melbourne, actually. And I would only be buying very close to the city, the good streets, and I wouldn't be buying anything else, to be honest. And I think, so that's kind of, if you're going to ask about where the market's going to go, I think they're the only assets you'd be buying. And so they're the assets that if you were thinking about getting in before the negative gearing change, they're the assets you would buy, because one, if negative gearing does go, the assets that will do really well are the housing market, because people won't invest and it'll just be more homeowners, and all homeowners roughly want the same thing, good lifestyle benefits, a nice street to live in and good schools and good transport links. And so what's actually negative gearing is going to do is actually force more people into home ownership. So, I guess that's where people will put their borrowing capacities into homes. So I guess they're the assets you would think about buying, but the problem is just, do you get it at a good price? And that's really hard at the moment, because you just basically got to put lowball offers in and hope someone takes it.
And I guess the whole point here is you have to get granular. You have to really look into the local suburbs and understand individual properties and the locations. And all those averaging reports that you get, about what prices are doing, are completely meaningless.
Yeah. And just try to get the absolute, one property that you don't have to sell for a very long period of time. So, because that's where you're going to get the CGT benefit,
Yeah.
Because, if you sell your property in 10 years' time, it doesn't really make much difference whether you get a 25% discount or a 50% discount. But if you sell that property in 2045 or 2050, that's where that'll really pay off for you to get in. And so maybe if you don't pick the bottom of the market in these areas, you might save on the future CGT benefit, and so and then also your cash flow, you might be able to afford the cash flow this year because you get the tax back. But next year, your rent's the same, your interest is almost the same, and so your cash flow, you might not even be able to afford to manage that investment. So it's just something to really think through. But if you're going to go and buy a little unit or something, or an apartment, or you're a first home buyer and you want to get into the apartment market, I'd really stop you doing that, because you're probably better off to buy that next year, that unit, because there'll be no investors wanting it, and you'll only have to compete with other first home buyers, and and there'll be so much choice, because there'll be no other investors out there fighting for you. So that's a good thing.
Chris, I really appreciate your time today, and that's really good advice. The thing that I like when I talk to you is you get very real about the situation, and very, granularity is part of that, but clearly your experience shines through. So thank you once again, and maybe we can touch base down the track just a little bit further and see how this all plays out.
Yeah, and that's the thing, this isn't a small change, right, Martin? This is a massive change to the future of the housing market and how it's going to be, and I'm not completely against, just getting rid of it. I think we just need to, it is going to have an impact on the market. I just think it's not really discussed how and where it is going to hit, and how big it's going to hit. And, and I think the Labor are kind of saying, oh, it won't really affect anything. Well, it will, just because, you can't price that asset at that same price without negative gearing. And anyway, that means that people are going to lose out, but that's fine. It's just that, we just need to talk about the real risk, I guess.
Yeah, very good point, Chris. Well, thank you once again, and we'll catch up again soon.
Thanks, Martin. Cheers. Appreciate it.
Cheers. Thanks. Bye.